Hey, what's up everyone, and welcome to the School of Personal Finance. So it was about a year ago that I made the video called How to Pay Off Your Mortgage Faster. And that video is by far my most popular. It got a ton of love out there. But I still to this day get comments saying I don't really understand velocity banking, that I was able to pay off my mortgage in 6 years, that if you follow my advice, you'll end up paying double what you really have to pay if you use velocity banking. So I thought it would be a good idea to do a deeper dive into velocity banking and how it all works. So the first thing I'm going to talk about is the sales pitch that you hear on YouTube. There's a bunch of channels that talk about velocity banking and how you could get out of debt within 5 to 7 years. So I'm going to talk a little bit about that. And now the second thing is I'm going to go back and show you a clip from that original video where I talk about how mortgages work and how the interest works and how amortization schedules work, and also how home equity lines of credit work and how velocity banking works. Now, if you just recently watched that video, I'm going to have a little timestamp below so you could skip ahead to the third thing that I'm going to discuss, and that's where I'm going to actually do a breakdown of the example that all these people are showing about velocity banking on YouTube, where they sell you on that you could pay your mortgage, within 5 to 7 years. Not only your mortgage, all your debt within 5 to 7 years. So I'm going to go through the actual example that you see all over YouTube, and I'm going to break it down, and I'm going to tell you what I really think about it so that you could decide for yourself if it really works. And then the fourth thing I'm going to do in this video is I'm going to tell you what I think is the best way for you to pay your mortgage down. And it's actually kind of a combination of all of this stuff. So I'm not making this video to hate on velocity banking, but at the same point, I do want to bring light to actually what's going on and to show you, does it really work or does it not work? So I hope you enjoy this video. Let's get to it. All right, so let's start out with the sales pitch. In all these videos, they start out by talking about how banks rip you off, how they front load the interest, how they make all their money, all their fees, everything is in the beginning of the loan, that it will save you 67% of the interest and the time that it would normally take for you to pay off your loan. Another thing that they do is they use all these fancy terms that you don't know what they're talking about. So things like HELOC, which is a home equity line of credit, or a debt weapon, or a debt tool, or debt acceleration. They talk about shifting debt from these expensive amortized loans over to these simple interest lines of credit. They talk about how it will improve your credit score, how it will free up cash flow, lower your expenses. Now, all these things, they sound great. And in a weird way, some of them might actually be true, but it doesn't mean that you have to go through this process, this complicated process to make it happen. So I'm going to try to show you how you could do it without needing to go through this and how you actually would be better off as well. All right, so the second part, I'm going to show you some clips from the original video. And the main reason why I want to show you these clips is because I couldn't explain it better now if I tried to. So I did a good job explaining it in that original video, and it's really important to understand these things. So let's go watch those clips now. All right, so let's start with mortgages. Let's make the assumption that you're taking out a $300,000 fixed rate mortgage, 4% interest rate over a 30-year period. So now with a mortgage payment, you have two components of it. You have the principal and you have the interest. And the bank uses an amortization schedule. So they calculate exactly how much you must pay every month over a 30-year period. So at the end of it, you owe zero. Now that monthly payment that it spits out of this amortization schedule, it does not change. So even if you're going to pay more each month or you throw extra money at reducing the principal, your payment is going to stay the same. What's going to change month to month are those two components, the amount that goes towards principal and the amount that goes towards interest. And now the amount of interest that you pay every month, it is a direct mathematical calculation compared to how much money you actually owe at that time. So if we look at the first month, that's when you owe the most. You owe $300,000. If we do the simple calculation, 4% of $300,000, that is $12,000. Divided by 12, how many months there are in the year, that comes out to $1,000. So in that first payment, you owe $1,000 worth of interest. And that is the most that you are ever going to owe, because your payment in this scenario is $1,432. So $432 is going to go towards the principal to reduce the amount that you owe, and $1,000 is going to go towards the interest. And then they do the same calculation all the way through. So now let's take a look at how home equity lines of credit work. So home equity line of credit is just a revolving line of credit, very similar to a credit card. The big difference is that your home is the collateral. So you have to apply for it. You have to have the equity in your home to get approved for it, good credit score, all that stuff to get approved for it. But with a home equity line of credit, the money that you borrow on it, the interest is calculated daily. That's different than with a mortgage where it's actually calculated monthly. So if you borrow $10,000 on your home equity line of credit, the interest is accruing at a daily rate. So they take your interest rate, say it's 5%, and divide it by 365 days a year. So they're looking at how much you owe on that home equity line of credit every single day and calculating the interest on a daily basis. And then they add it up at the end of the month to come to your interest payment for the month. In the home equity line, it's revolving. So let's say that you borrow $5,000 on it and then you pay it off. Now you have it available again, just like a credit card. It's pretty simple to understand. So now the concept of velocity banking that these videos are based upon, how you could pay off your mortgage in 5 to 7 years, it's that you get a home equity line of credit. So you have your mortgage, you take out a home equity line of credit, and you use a chunk of the home equity line of credit. Let's say it's $10,000, and you prepay your mortgage with it. You throw it at your mortgage so that you're reducing the principal balance of that mortgage. And now by doing that, you are now reducing the interest that you owe on that mortgage because you owe $10,000 less on it. Even though you're still going to be making the same monthly payment on your mortgage, you now owe 10 grand less. So more of your mortgage payment is going to go towards the principal. So this is going to accelerate the pay down of your mortgage. But now you owe 10 grand on this home equity line of credit here. So what velocity banking is you use this home equity line of credit as your cash account, basically is like your checking account. So when you get paid, you put your paycheck in there. You take your paycheck, you pay down the line of credit. You then pay your bills out of the home equity line of credit. And you keep on doing this, using it, paying it down, using it, paying it down. And you just have a focus, you have a goal of paying it back down to zero and then doing it over again. So instead of having money sitting in the bank where you earn zero interest on it, you have it sit in the home equity line of credit because this is accruing daily. So if you park your paycheck in your home equity line of credit, you're not paying interest on those days because you have paid down the balance on it. And then when you actually need the money to pay a bill, you write a check out of the home equity line of credit to pay a bill. So now in that clip, I was talking about using a home equity line of credit for velocity banking. But a lot of these gurus, a lot of these people on YouTube, they actually talk about using a personal line of credit or a credit card to do the velocity banking. So in the example that I'm about to walk through with you, I'm taking the slides basically from the presentation that it seems like all these people use. It's like they've all been trained with the same exact numbers and the same exact example. So that's the example that I'm going to use, and they're using a credit card in this example. So I'm going to share my screen. Let's go through the slides. All right, so if we look at this first slide, this is the whole strategy right here. So if we look at the top right here, we see $5,000 coming in. That is your income. So they make the assumption that you have $5,000 after taxes of income each and every month. And now when that money comes in, they're talking about what a normal person does. They put it in their checking account and then they pay their bills out of the checking account. So $5,000 coming in. On the left side, the C stands for checking. So you have your expenses that come out. You have your $1,200 mortgage. You have your $600 car. You have $600 in credit card payments that you have to make. And then you have $1,200 in lifestyle. So that's $3,600 that you spend on your bills every month. And now lifestyle, that includes, gas, groceries, all of that fun stuff. And then on the right side, the S, that is for savings. So there's $1,400 that you're putting into savings every month in this example. And then if we look to the right of that, we have under loans, we have a mortgage, $200,000, 30-year mortgage, $1,200 a month is the payment, and that's at a 6% interest rate. So this example, I guess, is from a few years ago because, rates are much lower. They're about half of that right now for a mortgage. So, and then below that, we have the car loan. So a $25,000 balance, $600 a month at a 6% interest rate on the car loan. And now if we look to the left, we see lines. So this is the line of credit. This is the credit card. It has a $15,000 limit. $12,000 is what is owed on the card. So that is the balance. The payment to the card is $600 every month, and the interest rate is currently 21%. So now the first thing that I don't like about this example right off the bat is how many people do you know have $12,000 in credit card debt racked up, spent on, who knows what, and you're saving $1,400 a month out of your $5,000 net income per month? I don't know anybody that is in that situation. All right, so now let's go to the second slide. And this is where they show that you should not be saving $1,400 in a savings account when you have credit card debt and you want to get out of debt, right? So they put a red X through that. You're not going to do that anymore. So now you have $1,400 that you could use towards the debt. So far, I agree. That's the first thing that you should do. But now what they're saying that you should do is the $5,000 of income that you have coming in, instead of having it sit in your checking account and then paying your bills out of your checking account, what you should do instead is move it over immediately to the credit card and pay down the credit card by that $5,000. So the $5,000 goes direct deposit into your checking account, and then you take it and you immediately pay down your credit card by the $5,000. Now, by doing this, because you have a $600 payment on your credit card, when you put $5,000 into the credit card, it acts as a payment. So you no longer have to make that $600 payment anymore. So they claim that what they're doing by going through this is that it saves you $600 in cash flow, that you now have an extra $600 to pay towards the debt. So right off the bat, they've created $2,000 in cash flow for you by taking the $1,400, stop putting it in savings, and by eliminating that $600 credit card payment. Sounds great, right? But now you have to pay your bills. So you have your mortgage, which is $1,200, you have your car payment, which is $600, and you have your lifestyle. You have to go to the grocery store, maybe you go out to eat, you have to get gas, so that's another $1,200. So that's $3,000 that you have to spend throughout the month, and you don't have any more cash. So what you do is you pay it using your credit card. You pay it out of your credit card. You pay your mortgage using your credit card. You pay your car payment using your credit card, and your gas and everything else. It's all done out of your credit card. And then at the end of the month, that difference, that $2,000 cash flow, that has now paid down the debt on the credit card. So you started the credit card with $12,000 that you owed. You put $5,000 into it. So now it's down to $7,000. But then you had to take $3,000 back out to pay your bills. So now you owe $10,000 on that credit line. And the way they sell it to you is they just helped you pay off $2,000 worth of debt, which is correct. You owe $2,000 less. So now let's compare that to what a normal person would do that is not implementing the strategy of velocity banking. So you would have $5,000 go into your checking account. That is your income. You're not going to save the $1,400 because it doesn't make sense to do that. You want to pay off your debt. So you're going to take that $1,400, you're going to send it to the credit card to pay it down. Now you also have to send the $600 payment to the credit card. So $2,000 has been sent to the credit card. And then you have your mortgage, you have your lifestyle bills, and you have your car payment, which are $3,000. So it's the exact same as the velocity banking example. $3,000 are going to your lifestyle and your bills and everything. $2,000 is going to the credit card. It is exactly the same. So what is the difference? There is one difference here. The difference is that when you do velocity banking, you are taking that initial $5,000 worth of income and you are putting it in the credit card. So when you do that, because the credit card, the interest is charged daily, you reduce the balance by $5,000, you are reducing the amount that you owe on the credit card. So you are going to have some interest savings here with the velocity banking. This is true. Let's calculate how much interest savings you would actually have. So there's $3,000 extra dollars that starts off sitting in that credit card, reducing the balance and lowering your interest. And then you're going to have your mortgage payment, you're going to have your car payment, and you're going to pay your lifestyle bills from the credit card throughout the month. So now most people, their mortgage, it's due by whatever, the 10th of the month. So maybe you could get a few days where you have that money sit in the line of credit, in the credit card, before you actually have to send it out to the mortgage. Same thing with the car payment and then your lifestyle stuff. So in the good example, in the good case scenario, I would say that maybe you're reducing the average daily balance in that credit card by, let's call it $1,000 throughout the month. So the example that they use here is a 21% interest rate on that credit card. So now if you're able to reduce the average daily balance by $1,000 throughout the month, then you're going to save 21% on that $1,000 for the month. Now we went over before how to calculate the interest on the revolving line of credit. It accrues daily. So in that example, we would have $1,000 times 21% interest divided by 365 days. And we would multiply that by the amount of days in a month. So let's say it's 30 days a month. When it's all said and done, it would save you around a little over $17 of interest for the month. So let's call it $20. So $20 in interest savings by going through this compared to just going ahead and doing it the way that most people do it, putting it in your checking account and then paying your bills out of there. So by doing the velocity banking, just to say it again, you would save in this scenario, let's call it $20 a month. Enough to take your significant other to Chipotle and get some burritos. But now let's take it a step further. So in this example, they're using a credit card. Have you ever tried to pay your mortgage with a credit card or your car loan with a credit card? It's not an easy thing to do. My lender, my mortgage company, will not accept a payment with a credit card. The only way that I'm able to actually do that, and this is the same thing with my car payment, the only way I'm able to do that is if I use some third-party service who will help me with a workaround. So you see these guys on YouTube, they pitch a company called Plastique, where they will go ahead, they'll charge your credit card for you, and then they'll send a check to your mortgage company or to your car company or whatever. But they charge you a 3% fee to do it. So on a $1,200 mortgage, if I want to go through this to get this done, on a $1,200 mortgage, I'm going to pay $36 in that month to have it go through my credit card using this third-party company. So I'm saving $20 in interest by going through this whole process, and now I got to pay $36 to have my mortgage paid from my credit card. So they show you here that you start off with $12,000, you drop your $5,000 income into the credit card, and then you write your expenses out for $3,000. So month by month, you're going from $12,000 down to $10,000, down to $8,000 to $6,000 to $4,000 to $2,000, and then this is completely paid off in 6 months. And you have, voila, paid off this line of credit in 6 months using this strategy of velocity banking. But spoiler alert, it's the same exact result. There's nothing different. And like I said a minute ago, I think it's actually cheaper if you have to figure out a way to pay your mortgage and your car loan out of your credit card and pay service fees in order to get that done. And then another thing that they're always talking about in these videos is by doing this, a big advantage is that you could reuse the money, that you have the availability of the money. So you don't need to keep any cash in the savings account because if you have an emergency, this revolving credit is available to you. So that's where you see this red emergency number in this green line. They're showing that you have up to $15,000 in the credit line available in case something were to happen. But guess what? You could just get a credit card, not use it, stick it in your drawer, and say that that's for emergencies if something happens. You don't need this line of credit in order to do that. You could get any credit card and have it act as your emergency fund. Or even better, if you do have a home equity line of credit, you could use that as your emergency fund. And then in this next slide, what they're showing you is that once you've now paid that credit card debt down to zero, what you do is you chunk. You take a chunk from the credit card and you repeat the process. So you take $12,000 from the credit card and you throw it at your mortgage. You prepay your mortgage, which in turn is going to reduce the amount you owe on your mortgage, and it is going to help accelerate the interest payments. This is what I discussed in that clip from my original video. So that is true. But the question is this better than just paying an additional $2,000 per month towards your mortgage? Instead of borrowing 12 grand on the credit card and prepaying it all in one chunk, how does that compare to just keeping your life easier and taking your $2,000 of extra cash flow and prepaying the mortgage every month with that? So let's look at the numbers. So now in this mortgage calculator, you could see starting balance is $200,000 in the first month. So our payment is basically $1,200. In the first month, we're adding an additional $12,000. So we're taking a chunk from the credit card and we're throwing it at the mortgage. 6 months later, the balance that we owe on there is $186,487.34. So now let's compare that to if we just pay $2,000 a month for those 6 months. So here we go. So if we pay $2,000 a month for the first 6 months, at the end of those 6 months, our ending balance would be $186,639.36. So in this example, velocity banking would have won out by $152. But wait, there is more. So one thing that is not being calculated in these numbers is the interest that you have to pay on the credit card for taking the $12,000 and borrowing it to prepay your mortgage. So let's look at what the interest cost would be. And I'm getting this information directly from the slides that they use in their presentation. So on the credit card at 21% simple interest, if you borrow $12,000, 21% divided by 12, they show that that equals $1,260 every 6 months. So in this example, you are paying $1,260 of interest to save $152.02 compared to just paying the extra $2,000 on your own. So am I missing something here? I don't get it. All right, so you're paying over $1,000 extra to do the velocity banking compared to just making additional mortgage payments. Doesn't make any sense to me. And they even go beyond that by selling it, by saying, look at how much you save. So by doing this, the pitch on this slide is that you're saving $45,000 of interest over 4 years by doing this chunk from the credit card. So it's worth paying the $1,260 in interest. So you pay $1,260 to save $45,000. Who wouldn't want to do that? But that's not the true full story. So yes, if you're not going to do anything, then velocity banking is much better than doing nothing, than not saving any additional money towards your mortgage. Velocity banking is better. But when you compare it apples to apples to just making additional payments to your mortgage, it seems pretty obvious to me. And not only that, but it's amazing how they tout it like it's this amazing concept, this amazing strategy. When we actually dig in and look at the numbers, it's just not that. So then in this next slide, they go on to say, repeat this process every 6 months. The example, American household will pay off their credit card, their car loan, and their 30-year mortgage in about 6 years using this strategy without sending in extra payments, refinancing, increasing income, or living on rice and beans. We simply use the velocity banking strategy. And now you know where they're getting their car being paid off through this process? Just by making the regular payments on it, because the car loan, they said, was a 5-year loan. So 6 years later, you're done paying for the car. So it's not even like the velocity banking had anything to do with paying down the car. You just sent in your regular payments, and at the end of 5 years, you were done with it. So they kind of bulk it in there with everything, saying that you could pay off your car doing this as well. But you're just making the normal payments on the car. All right, so to wrap this up, let me tell you what I think is the best way to go about doing all of this. And it is very similar to velocity banking. So now, if you're able to get a home equity line of credit at a low interest rate, like currently the prime rate is 3.25%. I personally have a home equity line of credit at 3.25%. That could be lower than your mortgage rate. If that's the case, it could definitely make sense to take a chunk from your home equity line of credit and pay down your mortgage. So you start accelerating the payments to the principal on your mortgage. And then to take that even a step further, if you have a credit card that you are good with using, that you understand how it works. You don't even need a 0% intro rate. What you could do is all of your variable expenses throughout the month, all of that lifestyle number, you could use your credit card throughout the month to pay for all of those things. And then at the end of the month, when your credit card bill is due, you pay it all off using the home equity line of credit. So you pay your mortgage, you pay your car, the bigger expenses, you pay them as you normally would. But any excess money you dump in that home equity line of credit, you use your credit card all month long, and then you stroke one check to pay the credit card bill off at the end of the month. This could save you money, and it's not that hard to implement. I don't ever think it's a good idea to use a 21% interest credit card to do velocity banking and then to try to pay your mortgage out of it and try to pay your car payment out of it. There's just not enough savings there. And if you have to pay fees in order to do it, then it eliminates the savings. Then there is zero savings. But I always think that it's a great idea to get very focused on paying off debt, to try to optimize all of your cash flow, everything that's going on. It's silly to keep money in the savings accounts if you're earning zero. Meanwhile, you have high credit card debt or high car loans or any of these balances that you're paying a lot of interest on. It doesn't make sense to do that. But you have to cover all of your bases. You have to make sure that you do have emergency money available to you in case you need it. I personally don't keep a lot of money in savings accounts. It doesn't make any sense. I would rather invest that money, or I'd rather park it in my HELOC and lower the interest on that. And then if I have an emergency, I could pull it back out of there. That's the strategy that I currently use, and I think it's the best way to go. All right, everybody, that is it for this one. I hope that you found that helpful. This is a confusing topic and there's a lot of moving parts. So hopefully I made it somewhat easy for you to understand. I know that it is confusing. Please make sure to smash that like button if you enjoyed this video. Hit that subscribe button as well. I will see you again next week. Thanks a lot.